In today's video, I'm going to give you my top 3 growth ETFs that are pretty interesting for the Canadians up here in the Great White North. Basically, these are all ETFs that are on the TSX. So let's get down and let's check these out. See if they're good for your portfolio or mine. Okay, so the first one we are going to be looking at is the iShares Core Growth ETF portfolio, XGRO, on the stock market. From there, it was up 4 cents the day of recording this video, and the average volume is about 96,000 shares per day, which is enough volume when it comes to an ETF for you to be able to get in and out of quite easily. The MER is actually quite low when it comes to ETFs. It's 0.18%, which basically means if you don't know about ETFs all that much, basically it costs money because you are allowing somebody else to do your investing for you. And because of that, they take 0.18% every year from your portfolio, whatever you put in. So if you were to put in $100, for example, that would cost you 0.18, which is of $1, which is 18 cents. So it's essentially costing you 18 cents per year for every $100 that you put in, or $1.80 a year for every $1,000 that you put in. From there, that's totally okay because what you're hoping for is that money to grow a lot larger than 18%. The nice thing with all of the ETFs that I'm going to talk to you about today is that they all have a dividend because, of course, I am a dividend investor. I like dividends, and this one does pay 2%. The only reason why I may shy away from some of these names is because they are near the 52-week high of 24.50. It is currently at 23.98. However, that is a pretty good pullback from its 52-week high. Now, when we look at the chart, it has been trading since 2018, and in 2018 it was worth $20 a share, and of course 2008. Since 2008, it has been started at $20 a share, and it did tank. Now, it did tank because, of course, as we all should know, there was a massive recession in 2008 and 2009. Now, the only thing that does scare me when it comes to growth ETFs is the amount of time it takes to come from a low, from a recession, and recovery to the point of where it was before. And of course, it took all the way from 2009 all the way to 2015-16 to be able to come anywhere close to recovering back to your initial investment if you were invested at the beginning. However, it did take until 2017-2018 to be able to actually recover back to $20. So it went from about $10 to $20 in about 8 years. Now, when it comes to growth stocks, if you were to invest in some growth stocks, some growth names that, of course, we know of with basically foresight from after the fact, but some of the names that we could really invest in back in that time was stuff like Microsoft, Apple, big blue chip stocks that did take a little bit of a hit in 2008 and 2009. And they had promising futures. This is why I always like to say to everybody that if you are about to invest in a growth stock, and we are currently in a recession as an example, you want to look out 10 years and say, where will this stock be in 10 years if it doesn't go bankrupt during this recession? And of course, when it comes to ETFs, they have to have a certain amount of names when it comes to growth names as well. And of course, this one did well because, of course, it did double in 8 years. But when it comes to a Canadian bank, you can double in 10 years. So that's the kind of trade-off that you're looking at. A little bit higher dividend versus doubling in 2 years earlier. And then, of course, there was the recession that we had during the pandemic of COVID-19. but it did recover quite fast. Now, many stocks did recover quickly. Banks did not until today and recently, and other stocks, other growth names recovered very quickly. Now, some of its top 10 holdings currently are Apple, Microsoft, Amazon, Shopify, Royal Bank of Canada, TD, Canadian National Railway, Enbridge, Bank of Nova Scotia, and Facebook. Now, as we can see, none of these make a massive contribution to your overall stock because companies like Apple only take up 2% of this ETF, which is kind of interesting because we don't usually look at Canadian banks as a growth stock, yet they are in this growth ETF. The next ETF we're going to look at is Vanguard, and that is XGRO on the TSX. What we are looking at is a expense ratio of 0.22, so a bit higher than the iShares ETF. And when it comes to the yield is actually a bit lower at 1.8%, and iShares was 2%. From there, volume is 150,000 shares per day on average, currently traded at 300,000 shares, and its 52-week high is $30.48, which is about 50-60 cents off of its off of its high right now. Now, this ETF did start in 2018, and it started roughly at that $24.50 range, and it did pretty well stay within a range from about that same price up to about just past $25. Now, there was a little bit of a downturn at the end of 2018, and then we did have a nice recovery all the way up until the current pandemic that we have. Now, just like every other growth ETF and growth stock, we notice that all of them traded within a good range and a good increase in share price. Is this sustainable? No, I don't think it is. You cannot continue to go to the moon. This is going to level out eventually. However, from the beginning, we have had around a $6 increase in share price, which is about a 30% growth since 2018. When it comes to its holdings, it does hold other ETFs. Now, you don't have to worry about when it comes to those ETF prices. They're baked into your MER in this ETF. That's why I would assume that the MER is a bit higher than the iShares ETF. The only issue that I see with these is the fact that when it comes to these ETFs, you are essentially watering down the amount of stock per share that you hold to a point where it is no longer, in my opinion, a massive growth ETF. However, this is still a great play, and both of these ETFs are great plays on the current future over the next 6 months to 1 year. Now, the BMO Growth ETF is actually quite interesting. Its yield is quite substantially bigger than the other two at 2.5%, and its MER is also 0.18. Its volume is a bit lower, but it is a newer ETF as well. It's XGRO on the stock market on the TSX. Now, again, it's not a very old ETF. It's only been trading since February of 2018, and it had a very nice growth since then. Obviously, pandemic hit, and then it's had a nice growth again. So it's also been trading within a range, and it's about to hit a point. What will happen at that point? Well, I think it's going to continue to shoot up. This is one of my favorite ETFs when it comes to growth. Now, this one does have an interesting holding system as well. It's holding ETFs too. It's holding all BMO ETFs for obvious reasons, but it's holding the BMO S&P ETF, which is interesting because that is an index ETF. So you're basically holding index ETFs for your top two positions. Then you're getting a little bit of growth, massive growth, usually not that one, in the emerging markets ETF. And then you're getting a couple of bonds to pay the dividend. Now, the reason why I like these ETFs is because, of course, you're getting better growth than what you would normally get in a dividend ETF, and you're still getting a really good dividend. That's why I like these 3 ETFs. They have kind of an interesting stock portfolio, I should say, but they do seem to be pretty well set for the future. I hope that you've enjoyed today's video. If you have, hit that like button, subscribe. Remember, never trust a random guy on YouTube, and I'll see you guys again next time.